Welcome to Bunnex Investment Group. This is a course on smart money concepts that are actually trending right now. We'll go through everything we need to know pertaining these smart money concepts. But before we go through, make sure you subscribe to this channel and check the notification bell icon so that you will not miss any of our videos when we upload. So in this course, we are going to talk about what smart money concepts are, then the liquidity grab concept. So this is basically the start of the smart money concepts. From the liquidity grab, we are going to jump over the change to the change of character concept, which is now an application of what would have learned in the liquidity grab concept. Then the last but not least is now the Orderblocks concept, which is now an application of the change of character. So it's 1, 2, and 3, and for you to understand the war smart money concepts, you need to watch to the end of the video. So the first topic is, what are smart money concepts? I'm sure there are a lot of people who are actually wondering what these are and are they a holy grail in our trading? So these are techniques aimed at mimicking how banks trade. So we are trying to follow how large institutions participate within the markets. So we'll be reverse trading the retail trading concepts. We have our common retail trading concepts that looks at trading the support, the resistance, sometimes calling them the supply and the demand zones. So with this, we will know what to do whenever prices reach the support and resistance zones. So smart money concepts looks to get involved in the markets in line with what the bigger institutions are doing. So what they are doing is what we try to do as well. The second topic is the liquidity grab concept, which is actually the foundation of the smart money concepts, or the SMC in short. So banks and other institutions, right, have access to large amounts of capital. They actually trade with capital of, for instance, 3 billion, 500 million, and so forth. So this calls for them to open very big trades. Whenever they are opening trades, they don't use micro lots or mini lots. They use standard lots, actually thousands of standard lots. You'd see a position of around 13,000 lots buy, 13,000 lots sell. However, big trades requires liquidity to be filled, right? What do we mean by that? If someone sell to you, if you sell to someone, there should be someone who is going to buy from you. So for a trade to be filled, it needs a corresponding seller or a buyer. So for them or for their trades to be filled, they need someone who is going to buy or sell from to them. So to do so, banks will look to find high liquidity points to grab. If they grab the liquidity, or if they push the markets to the liquidity zones, they will be able to attain people who are going to buy from them, or people who are going to sell to them. So liquidity zones are usually built up with the retail traders' stop losses, right? So the retail traders' stop losses, if you buy, let's say you buy Euro USD, put your stop loss here, right? Whenever price come to your stop loss, you are now forced to sell, right? So if you sell, you actually sell at a very lower price than what you have entered in. So that means you will make a loss. So have you ever wondered where those funds go to? They're actually linked on the interbank, and those funds create what we call the liquidity within the market. So that's the liquidity these big institutions or the smart money will be looking for. So here's a basic illustration of how they grab the liquidity. So within the market, usually price can tap a zone twice or thrice, and that is actually a way to convince traders to take positions within that point or zone. So we usually call an upper band or the resistance zone the supply zone, and the support zone the demand zone, like this. So usually the price will actually be made to oscillate between these bands, so as to it's actually a way to convince traders or lure traders to take positions, right? In these zones, all know that retail traders will be actually trying to sell the market, and in these points, retail traders will be actually trying to buy the market. However, due to the techniques that are in Hedge Fund 101, there are several ways to create accumulation phases within the market. Like cyclic trading is one of them. There are a lot of them. So in that case, you'd see that the market can actually be pushed to take off the stop loss levels of the buyers within the demand zone, right? So this is basically a way of liquidity grab. So within doing so, there are some who actually enter the market as a way or as breakout trader style, right? Those will be actually cancelled and taken their stop losses when this kind of move occurs. So after liquidity grab, usually the market will now result in a long sustained run. So liquidity grab is basically a way where the smart money actually pushes the market above the points they actually entice the traders to take positions, right? Let's have a market example. So this is a point whereby the market was actually oscillating. We can see this supply zone and this demand zone. So within this space, we were actually accumulating traders. So buyers were actually induced at this point, as well as sellers were actually induced at this point, right? After that, we can see that the market, after inducing these people, it actually went below this demand zone. So this was now what we call liquidity grab. This was a band where most stop losses were actually concentrated for the buyers. Then after that, we can see a long sustained run going away from that liquidity zone, right? So we'll see how we actually apply this liquidity grab in the next topics, which is CHOCH. So let's now talk about change of character or CHOCH, which is now an application of liquidity grab, right? So CHOCH is a break of structure towards the upside and then downwards, towards the downwards or vice versa. Let's repeat that definition so that you actually get it. Change of character, right, is break of structure towards the upside and then towards the downside or vice versa. We may say it's a break of structure towards the downside, then towards the upside, right? I know it might be confusing, but in illustration form, we can see that when the market is actually trending up, right, like that, we reach points whereby we want to see a reversal point. So in this case, we can see this impulsive move, this one, actually broke structure here, right? After breaking structure, we can see the market breaking again structure. So in short, we may say change of character is a double break of structure, right? We had the first break of structure and the second break of structure. This was for a downward change of character. Then for an upward change of character, we may see this impulsive move actually breaking this structure, right? Breaking this low. Then later we saw this breaking this structure, a double break of structure, up and down like that, right? This is to simplify how most of the people actually define this concept. So CHOCH is basically an application of liquidity grab since there is double break of structure on the upside as well as on the downside. So why are we saying it's an application of liquidity grab? We can see that we are saying, right, this is a law that has been created. If we break that law, right, if we break this law, we are actually trying to grab the liquidity that is available in this zone. Then would see the market breaking this structure, right? That is basically change of character in an upside direction. So double break of structure is a way to grab some liquidity within the markets. However, there are good points to look for CHOCH in the markets, right? It's not always whereby we actually try to get this change of character. We actually look for these points for change of character at higher highs or higher lows, right? Let's say the market is actually trending with the concept of market structure that we know from price action. We have a higher low, a higher low, a higher low. So in these zones or in these points, that is where we would look to get, right? In this case, there was an uptrend, this one. So magnifying that uptrend, we have break of structure, right? Break of structure in these points. So this is a magnification of these points, right? We need double break of structure within these higher lows, right? So that is how you would know the where to end off these pullback moves, right? So just an example, in this case we are in a down trend, so we are looking for CHOCH at higher lows for the market entries, right? This was a higher low, right? In that higher low we can see the market actually breaking structure here, break of structure that occurred here going upside, and then we can see the market breaking of structure on the downside, and at candle closure of the last breaking of the last breaker is where we enter the market. So what we call the breaker is this candlestick that actually finishes off the breaking of the second structure, and we enter the market and we are done. So that is a change of character. Then change of character is now to be applied with order blocks as well. So we need to actually define what order blocks are. So order blocks concept is now an application of the change of character, not an application as such, but we now need to apply the change of character concept within the order block concept. So order block is considered a market behavior that indicates the pile up of orders from banks and institutions, right? So the central banks and financial institutions mainly drive the market, as I have defined earlier. The market tends to make sharp moves on either sides once the order block is completed. So whenever the market makers, these smart money, get involved within the markets, we will see a very fast moving phase within the market. So the key behind order blocks is that it includes what giant institutions are doing, right? So market makers or large financial institutions needs to trade wisely, otherwise they can lose money to retail traders. So if they just come within the markets, put a 13,000 lots on a support zone, usually everyone can see it, and their orders will remain unfilled. So it will be free funds to us, the retail traders. So they need to be wise. So if they decide to buy or sell any particular asset with high volume, they need to split their positions. Buying all in will actually result in contracts not filled and will result in sharp spikes of price that can allow retail traders to enter the market, and this will negatively affect on their profit. So to avoid this, they do this. They actually split their positions. Say they want to ultimately buy 100,000 portion of EU, they can split it into two 50k portions of EU. In this case, we are saying at this point, right? At this point, that is when they actually got involved in the markets, right? That is when they actually made their buy, right? This is their point or their price point. They made their buy. They wait for an impulsive move due to the injection of the first positions, first chunk of positions that they have put, then perform what we call cyclic trading that allows them to return to the same price like this. At the same price like that, that is where they actually add more positions within on top of the first chunk of orders, then they actually go up, right? Like that. So this point or this candlestick involved in the first chunk of orders is what we call an order block. That is a block where the large institutions positions are located, right? So in this case, we can see the first chunk was actually introduced at this point. Then the market actually comes back to retest as shown at this point. So at this zone, that is when we actually try to look for change of character movement, right? In this case, this was a down move like that, right? We now wait for break of structure and break of structure 1 and 2 and enter at the closure of the breaker, right, of the last breaker in this move. So that is the pattern that we will look for at this point. So basically this is what we call smart money concepts. You'd see there are several things that complicates these things, and I'm sure you've seen that it's basically something that you'd have known that has been given new names. So there's nothing fancy about the smart money concept. It's not a holy grail. It's something that is out there, and others are actually charging a lot of money for this to teach you. So there are other concepts of the market structure, the linkages of the market structure from the higher time frame down to the smaller time frame and so forth. We all know that from price action, and this hasn't been covered in this particular short course. So on that note, we come to the end of this video. Thank you for watching. Like and subscribe, and you may as well check out our free Telegram channel. The link is this one, and I'll leave it also in the description box below. See you on the next one.